All right. What's going on, guys? So I'm back from Nashville here. I know that what I wanted to keep doing is I actually wanted to keep doing these market. I don't even know what you really want to call it, like market live streams over, every single Sunday, like I have been doing. But I had about a week there where I was basically out of town, going on a national sales meeting, is what they end up calling it. It's a huge sales convention. It's a lot of long days and big meetings. Hey, what's going on, Sam? So, all right, we got a couple things what I wanted to talk about here today. I think that there's a lot of really concerning things that are going on out there in the markets. Um, right now, at the moment, from like what I've seen, so from the last time that we ended up talking to now, what I ended up seeing is that there is a lot of excitement around certain stocks. Now, I think it's very important to like mention that I do understand and I do know that it is justified. Meaning like Nvidia's earnings, absolutely rock star. SMCI, this is real earnings growth. So there, it seems to be that a lot of companies are following earnings trajectories and not just based on revenue alone. So because of that, I do think that there's not, 2021 vibes or anything like that. But I do think that overall market risk is extremely high. And I actually have my portfolio pulled up right here. Now this really sucks because when I see it at where like where we are today, it's like I know that I'm going to have to show publicly a portfolio drawdown, and this is usually a really tough thing to do. The dot com bubble, so it's not anywhere near a dot com bubble in any way, shape, or form. So, and the reason why I say that is that like I mentioned with Nvidia and SMCI, these are driven by real earnings. And I think that what's going on right now is actually like a price discovery. So like what is Nvidia's actual revenue growth going to be over the next 3, 5, 10 years from now? And I think that maybe there's a strong chance that we do overshoot that. But at the moment, like right now, it actually seems pretty justified, which is why you continue to see it. And the multiple is not even expanding. You just see upward earnings revisions on Nvidia. Now, SMCI, I think that that one's probably a bigger risk than Nvidia at the moment, mostly because they have just a massive customer concentration. It's like somewhere around 70% or 80%, and there's also like a really strong competitive environment with SMCI. Sorry, I just ended up getting a text, guys. This is a live stream, so and it's obviously all in my ears. But there's a lot of competition risks. So like Dell does a lot of the same thing as SMCI. So like that's something that I'm seeing, but Nvidia doesn't have those risks. So I do think that overall, there's a lot of like structurally it's okay in the markets. Like I can't see any sort of 1999 bubble collapse or anything like that. What about Net and ARM? Okay, that's a good question because everyone's talking about that. I think I'm going to cover that here in just a second. So I'm going to cover a lot of the software stocks and a lot of the valuations on individual companies. But what I want to do is like I mentioned, it does suck to know that I think that the markets are going to correct pretty substantially. So let's go over the markets. Let's go over some of the stock valuations that we see. So like on a forward PE basis, as well as like a next 12 months EV to sales, like what we can expect in some sort of drawdown. And and then we'll be able to get a better understanding of like what the strategy should be moving forward. At least that's what I'm going to end up doing. So I'm going to actually be able to share exactly what my strategy is going to be moving forward. And even though I'm expecting a portfolio drawdown, how am I preparing for that, right? Am I selling stocks outright? Am I doing some hedges? Or am I just trying to raise some cash? So that's what we'll cover. I think it's important to put the correct context as well here that this is exactly, I love this image by Brian Feroldi. This is on his Substack. This is basically the game that I'm trying to play, right? So you guys are going to see periods of time where I am going to underperform the markets, and you're going to see periods of time where I'm just absolutely crushing the markets. But the overall goal is to continuously outperform the markets over time, and that does include the Nasdaq, not just the S&P 500. And it's actually really tough, and it's really tough because there's a lot of I mean, you're basically, so for me, I don't own Nvidia, and I don't own Meta, and I don't own Apple, and I don't own Microsoft. So there's a lot of I mean, it's really hard to outperform these companies in general because they're just profit beasts and they're just beast of companies. So I'm really thinking about individual stock picks. So I do expect a lot of beta in my portfolio. So let's talk about the markets here. When I talk about stock market drawdowns, it's very important to realize and understand. So, like, sometimes the narrative in the markets will talk about, like everything's just going to keep going up forever. You don't really want that to happen. So, I mean, this is back in the 1960s and 1970s. drawdowns in the markets are about as natural as like summer and winter. Like it's going to happen. You should always expect it. And it's more about like preparing for that drawdown to happen rather than just outright avoiding it. Because over time, obviously, you can see that things keep going up. But if they don't consolidate and if we don't actually end up getting a correction, then what we end up doing is we end up leading into this secular bear market status. So this is what happened in the 1999 dot-com bubble. And then we went through this massive secular bear market, which was pretty catastrophic and left a lot of emotional scars for investors. I don't want that to happen. I just want a correction, like something that would actually bring prices down to a little bit more normalized levels. So, like as we look today, I got to go to the next tab. So as we look here today, we can see that this is the S&P 500. And what I did is I actually put in like what sort of drawdown we could expect from if we go down to the 200-day moving average, which is about 12% drop. It's not a big deal. 12% drop, I mean, that's not something to be concerned of. I would even, for me, I have hedged my portfolio before, but I don't really look at a 12% drop, something that would be a meaningful hedge. I mean, 12% is really not that much of a gain if you're going to actually short the actual markets. This is a lot more of like a hiccup. It's going to basically will recover at the back half of the year kind of thing. But if we do get some sort of broader economic weakness, maybe data starts coming up, real acceleration in inflation or some sort of recessionary economic data, I could see us going down to the 200-week moving average, which is about a 20% drop. So that would be the equivalent to like the back half of 2018 bear market. So when you do look at the markets from a technical perspective too, you get the RSI is extremely overbought on a weekly basis. Historically, this is about the time when you start actually seeing, major market corrections. So you can see right here in 2020, now we're about that overbought to 2018, etc. You guys kind of get the point here. When you actually end up getting really overbought signals here on the S&P 500, this is usually the time to be more risk averse. Usually about the time to be like, okay, how am I going to start planning to yourself? Like, what am I going to do to take advantage of the coming dip? Because it's going to happen. It has to happen. And if it doesn't happen, then we end up going through, it's going to eventually revert back to mean, which what I would consider is this 200-week moving average. So, and I'm going to talk about this here in just a second. But let's first cover the NASDAQ. And the NASDAQ is showing a similar story here as far as what sort of drawdowns. And we're obviously overbought on the NASDAQ on a weekly basis too. Drawdowns, if we go back to the 200-day moving average, which is pretty normal. So I made sure to, the blue line is going to be the 200-day moving average. Green line is a 200-week moving average. Historically, the NASDAQ just crawls along the 200-day moving average. And any sort of corrections that go back, so like when you start getting extended substantially from the 200-week moving average, you can usually expect some sort of consolidation or correction to revert back to that 200-day. Same thing with the 200-week is when there is some sort of Fed policy shift, some sort of economic problems, usually you do see it revert back to that 200-week moving average. I mean, this 2016 correction, bear market, whatever you want to call it, almost hit the 200-day. 2018, 2020, and then right here we did the same thing in 2022. So like that would be a max drawdown of about 20%, which once again isn't going to that's not a 50% drawdown where it would be too devastating. But when we think about from a stock valuation perspective, this is where I'm actually getting the most concerned is when we do look at the forward PE on especially on large caps. So like this is going to be our NASDAQ and this is going to be our S&P 500. We're at about 21 forward PE. This really does concern me. And the reason why is that I pulled this up. This chart was really interesting to me on Yardini. This gives you an idea of like what sort of basically price discovery, like price variation that we could potentially see in the event of a correction. So in the event of a correction, historically, what ends up happening is that the market bottoms when the S&P 500's forward PE ratio gets low enough. Hey, I'm just going to check the comments here real quick. Yep. So, Sam, I am going to cover Mercado Libre and Atlassian here. But when we're talking about like what the max drawdown could actually end up being in the S&P 500 when we go back and forth between forward PE of 16 and forward PE of 20, basically what this ends up looking like is, so if you guys saw this little part right here, if we actually end up going more towards, like if we have a pretty nice correction where the forward PE just goes down to a simple like 15 or 16, this is basically the area that we're looking at for the S&P 500, which is revisiting the October lows. Now, do I think this is going to happen? I don't know if it really matters too much if I think it's going to happen. I think it's better if we think about it more of like this is possible. You know, this is more than possible. Actually, this is like like let's assign it like a 30% chance of it could potentially happening. And the reason why it could actually end up happening is that number one, the yield curve is actually still inverted. So right now the yield curve is signaling that we're still transitioning into an economic recession. You know, we've been inverted for quite a while. This is kind of renditions of 1989 to 1991 economic cycle where you actually ended up seeing a big massive drop first in 1987, which is the famous Black Monday stock market crash. And then eventually in 1991, we actually ended up seeing the recessionary bear market, which is what I think some sort of price action that I think was what we're actually going to go through this time. So paying attention to that is very important because that means that we're actually going to see some sort of drawdown, possibly 20, 25 percent. And even if you look at the forward estimates for the S&P 500, so this is the S&P 500 earnings, basically showing earnings per share for the S&P 500. And this, you actually have Yardeni's and you have analyst consensus. This is really something that I pay a lot of attention to. And the reason why I pay a lot of attention to is that it actually gives you, so you can see right here, this is 2025's estimate for the EPS for the S&P 500. So, and obviously I don't have like a calculator pulled up right here, but if we just do 270 times 15, you know, that's going to be about an S&P 500 price of about 4,000. So that would be like our base case at the end of the year's S&P 500 4,000, which is about a 10% correction from here. But if we ended up doing something similar to like let's say that we're still trading at about let's say we're trading at like a forward PE of 20 at the end of this year, then we do 270 times 20, and then we get about a 5,400 S&P 500 price target. So like that's how I think about it. Is like, okay, this is where I think that we could actually go. This is where I think that we can't go. More or less, to really simplify what I'm trying to communicate is that there's a very strong chance that we actually end up going through some sort of market correction, meaning that we could actually see a pretty substantial drawdown either to the 200-day moving average, which is 12% lower, or to the 200-week moving average, which is going to be about 20% lower at some point this year. You know, like I understand that it's not super popular to really call inflection points, but when you can see that the extremes are starting to happen, that's usually when I start to become really afraid, and I start thinking to myself like from a contingency planning perspective. My gosh, I don't think I talk so much as I do on these YouTube lives. Um, so I think that now what I want to actually do is I want to go back to my portfolio and talk a little bit about the strategy, and then I'm going to go into a couple different earnings. When I go into a couple different earnings, I'm going to talk about Mercado Libre. I did end up selling Indie Semiconductor, and I'm going to explain briefly why. I do think that thesis was absolutely broken, and I think I just want to cut bait, raise the capital, which goes back into my portfolio strategy right now. So like right now, what I'm thinking is I want to raise cash, meaning that I want to raise cash either through my 9 to 5 job. I want to cut businesses if I need to cut businesses. I want to make sure that I'm thinking about preparing for this next correction that ends up going on. So if we do end up going back and pulling back into like a meaningful area of support, so like I'm looking at the software names right now that have released really great earnings, like Cloudflare. Like I mentioned, I was going to get around to Cloudflare. So like Cloudflare, Snowflake, who reports earnings this Thursday, Datadog, who just had their recent investor day. Like these are names that are generating free cash flow, absolutely crushing it right now. And like these are names that I want as portfolio staples because I do think that they're going to be the next 10 to 15 year winners. Like there's maybe one or two of these names that do become like the next Fangs, the next Nvidias. Like especially Snowflake, I think has a high chance of that. Even Cloudflare, which business which this business just continues to execute on. Like I want more of these companies. And actually, let's go back to exactly what kind of companies I'm looking at here for this potential pullback. It's like the trade desk. This is all by weighting here, so you guys can see that. Like I want more Tesla. I want more Datadog. I want more MongoDB. I want more Cloudflare. The Trade Desk, DraftKings. Like these are names right here where I'm just looking for that stock market pullback to where I can actually buy these companies at fair valuations. Because right now things are very high. So you can see that, like I mentioned before, with this next 12 months EV to sales ratio, like this is at the high end of the range, and the only time that it's ever been higher is during a bubble. And then you can even see like what the next 12 months EV to sales is. So it's like 21 for Snowflake, 20 for Cloudflare. Like this is just too expensive. I can't buy these stocks at these prices. I could definitely see like a 25 to let's say 40% drop in the existing stock price right now today. Now, obviously, I'm sitting on a lot of gains for these companies, but when I think about like where I want to actually add these companies in heavily, this is the prices that I'm looking for, like 15x EV or 15x EV NTM sales or lower. That's basically what I'm shooting for. But they're free cash flow beasts. They're expanding their bottom lines. Like I'm not too worried about that. So that's really what I'm shooting for. And the ways that I'm really focusing on actually building my cash position is that I'm not looking to sell anything, more or less because like I do have a substantial amount of the stocks that I own right now in a taxable brokerage account. Yes, I do have a Roth IRA. Yes, I do have an IRA. But in that taxable brokerage account, it's just like, man, I hate paying taxes. I really do. I think I was just doing my taxes the other day and I was complaining about it for like hours because they take so anyway. I hate paying taxes. But I do like seeing my wealth compound over time. So if I don't want to take that instant like 15% loss on my long-term gains, so on my long-term holdings. But if I've held a position for under a year, that ends up being taxed like 40 to 45%, because it comes through as a 1099 and I have to pay on that at the end of the year. It's just not something that I want to do, you know. But so that's a huge reason why I end up just holding these stocks, especially if I'm bullish on the company longer term. So, all right, let's get into a couple different earnings. I think I'm gonna make sure I check on it. Yes, thanks, Satori. I appreciate it. Cassandra, hello. Good to catch you here too. So, all right, let's talk about Mercado Libre. And I don't usually do this, um, but okay. So Mercado Libre was down about 10% on Friday. But what I really wanted to actually direct you guys to was actually not Brian Feroldi specifically, but this is actually Brian Stoffel. He released a YouTube video that I thought, so like when I was listening to the call, the first thing I thought to myself was, is like, what's wrong with these analysts? Like, I mean, Mercado Libre, they ended up posting some pretty outstanding numbers, and I'll show you here. This is on Seeking Alpha. So they grew revenue, I mean, like 42% year over year. That's right now. So like Mercado Libre, what's the market cap? $82 billion company, growing 42% year over year. I mean, they're executing flawlessly on all of their initiatives, and they actually ended up expanding, or they're going through an expansion for their fulfillment centers. If you're not super familiar with Mercado Libre's business model, they're basically like the I like to think about them just like an Amazon, you know. So we know Amazon pretty well here in America. They host an online e-commerce app, and then they have a few other, and they have like the logistics and fulfillment centers and delivery centers. That's essentially what Mercado Libre does. And then they have a couple other things like ad tech, Mercado Pago, which is their payments, and then their credits. So that's basically their business model. But when you think about like exactly how well they've done, it's really incredible, especially in Latin America. And this is adjusted for inflation too. So they operate in Mexico, Brazil, Argentina, and all of them actually went through a really nice growth curve. But when I saw the shares end up selling off, the reason why I'm pointing you towards Brian Stoffel, so going back to here, is that, and I caught this on the call too when I was listening to it, is that they were really worried about the margins. They were really worried about like the operating margins as well as like the take rate margins. So when I saw that, the first thing I thought to myself was like, why are the analysts being so damn nitpicky about it? And it's really just because Mercado Libre did start to get a little, I wouldn't say it was overvalued by any means, but the valuation did start to get slightly stretched. So I do think that right now we're kind of at a point in the market cycle. And I saw this with Global E, where Global E's results predominantly came in line. But right now, I can tell that Wall Street is looking for reasons to sell businesses. And this is a huge reason why it's been a really crappy earnings season for a lot of investors if you don't own NVIDIA or SMCI or whatever. I mean, it's like right now the concentration and the leadership is so narrow, and this is usually indicative of what ends up happening in late stage, like right before a market correction. This is like is that usually leadership gets super narrow, and everyone, all the institutions start piling into the same three companies. And that's basically what we're seeing right now is like mega cap tech, mega cap tech, mega cap tech. And I can actually show you guys this. I didn't show you this chart before. And just to give you an idea of like what sort of bifurcation we're having here. So this right here is like the Mag 7, this purple line, which is now it's actually getting the forward valuations very close to the peak of the 2021 market cycle top, which is basically where a lot of the forward valuation and the weighting goes for the S&P 500, and probably why we're actually at a next 12 months or a forward PE of about 21. But if you look at the small and mid cap sector, I mean, this is extremely low. This is actually pretty consistent with like 2019's market low or 28 back in 2018, 2019 back 2018 market low. Back over here with like the COVID recovery, as well as even like the 2008 global financial crisis valuations. So like this is really where I'm thinking about like where the opportunities could be. But if those bigger cap tech companies actually end up selling off, I could see the entire market selling off and everything's just going to get cheaper. But that's okay. You know, that just means that it's going to be pushed down lower than its intrinsic valuation. So I think that every company right now that I'm seeing that doesn't report perfect earnings, much like Mercado Libre, is going to end up selling off. I don't think like I'm pretty cautious about this. So like Cloudflare, it was pretty expensive going into earnings. It was like an 18 or 19 for next 12 months EV to sales. But they ended up producing like rock star earnings across the board. So they were rewarded with a 20% multiple expansion. So like that's something that we're seeing right now. But if you're not coming in perfect across the board, this is usually about the time that institutions start selling off, especially when everything is super expensive. So let's look at actually some of the earnings that we got going on this week and what I'm paying attention to for these companies. And then I think that that's going to be. I usually like to try to do these in about 30 minutes. Um, and from Okay, awesome. So I usually try to like to do these about 30 to 45 minutes. And if you guys have any questions, I like to try to answer that at the end. If you guys don't have any questions, and you know, that's okay. Uh, but for Monday, I know that we don't have too much. I'm not really paying attention too much, especially when it comes down to Monday. I do know that like Brad Freeman owns Hims and Hers, ticker symbol HIMS, Hims. I do know that for what I'm paying attention to, like the next company I'm actually paying attention to is going to be Shift4 on Tuesday. So Shift4, a little bit about that. It's actually a payments platform. Oh, gosh, my mouth always gets so dang dry when I talk for like 30 minutes straight. So Shift4 is going to be a payments platform, and what I've really seen with this company is that it's executing really well. I'm really debating on actually adding a little bit more into going into earnings. And the reason why is that it's actually, I can actually probably pull this up here for you guys. Right now, today, it's trading at a line of resistance. So I can show you this right here. So this is Shift4. You can actually see that it's trading at like this little area right here where it wants to break out. If if earnings go well, I could see a candle look something like this, where it's just going to be this massive green candle go up and it's going to break out. And I could see it rallying all the way up to about $120 per share, is where I could see this going. So, and that's just where the valuation makes sense. So for me, I'm wondering if like maybe I should add a little bit more to Shift4 or not. But this is what I could basically end up seeing here for this company, and actually having it go back to all time highs. They're fundament. It's still fundamentally undervalued. They're doing really well. They're operating profitably. They're expected to grow like 40 or 50% this year. So I mean, like this is a no joke business. I don't know why it's even valued the way it is. I just think that payments companies right now just have an overall negative sentiment about them. So shift four, I'm really looking for them to actually obviously beat expectations. When they do beat expectations, I think that the stock price is going to rally pretty substantially. So let's go back over here. And then I was looking at, so I'm really not paying it. I know there's going to be a couple other companies here that people pay attention to, like Lemonade. Like Wednesday, I think that I got Snowflake reporting earnings. I'm not really, I know some people own like IonQ for the small cap portfolio. It's like Shy. He owns IonQ for small cap portfolio, C3 AI. That company's not an AI company. It's like some sort of weird IoT company that took the symbol AI. It's like I researched that company. I was like, it's like, what is this? Like the only reason why it got a boost at the beginning of 2023 is that it had the ticker symbol AI and ChatGPT came out. Like it was silly. Not a good company. Not a good company at all. But I'm looking for like watching Snowflake. I think that Snowflake, if we remember correctly from the last earnings call when Frank Slootman ended up coming out, Mike Scarpelli is Frank Slootman. Mike is going to be the CFO. Frank is the CEO. They ended up not really guiding, but insinuating that there was going to be some sort of revenue acceleration in 2024, mostly because of their Snowpark cloud offering, as well as some AI tailwinds. I do think that there is going to be a beat and a raise from Snowflake. I do think that they're going to beat on all metrics. I think that estimates are pretty conservative right now, because they really are doing a really good job providing the infrastructure needed to actually build and develop a lot of these AI platforms and new. I think they're calling them like inference models, and I think that Snowflake is going to be a massive beneficiary, not even just with AI. So, like, if the AI cycle changes, I mean, it's basically a data cloud. It's an infrastructure play on tomorrow's business and the way that tomorrow's business is done. So, I'm very bullish on Snowflake going into earnings this week. Not 100% sure what sort of multiple expansion we're going to get out of that one. It's already at a 21x next 12 months EV to sales. I would be looking more towards some sort of that raise. I want to know how much they're going to raise by for this full year. If they end up raising, meaningfully, I think that they could actually hit like somewhere around 35 to 40% growth, compared to like the 30% expected. So I know that a lot of people are going to be paying attention to Celsius. I try not to. I so I don't. I kind of like I don't want to be a hater on Celsius, but I do know the energy drink market pretty well, so that's always been a huge reason why I've let that one miss. I've really missed out on that one. I've had a couple Celsiuses, and it tastes like an energy drink, but obviously, jokes on me. I missed a multi-bagger. I knew this company when it was like $30 pre like split adjusted, so like before they went through their stock split. So I mean, I've really missed this company in a lot of ways, but I know there's going to be a lot of people paying attention to this. Pay attention to their international expansion. Also pay attention to like what sort of growth they expect for this next year. I could see the multiple contract if they start guiding for any sort of margin compression, which would probably mean that they need to market their products more. Then they can actually grow their products nowadays. So I'd pay attention to something like that, especially their sales and marketing line item. And I would definitely pay attention to like where's the max that they think that they can get for their market share, their total market share gains, because eventually they're going to hit like a max as far as the market share goes, and they're not going to be able to take any more from Monster or Red Bull and a lot of the more established players. That could be a long time. That could be a couple days. I don't know. I really like what that looks like. It's kind of dependent on the consumer. But then I have Zscaler. So Zscaler is actually a pretty important one, because Palo Alto created. I've never in my history of trading managing portfolio, I've never seen one of my companies go down 15% on another company's earnings before. Like when Palo Alto came out and said that they were discounting their products and stuff like that because of vendor consolidation, they deliberately said on the call, they said, we're not trying to compete in the best of breed businesses like SASE or XDR, which is Zscaler's best of breed SASE. So Palo Alto is not trying to compete directly with Zscaler when it comes down to SASE. What they're trying to do is they're trying to actually sell a platform-based approach, and they're discounting their products, and they're discounting and incentivizing the products. I think it's more of a Palo Alto problem. And I think that Zscaler is going to actually end up um, providing that insight for us, like especially and this is a good thing for CrowdStrike owners that ended up experiencing some selling too, as well as for me. I own Sentinel One, so I think that Zscaler is going to provide a little bit more certainty and structure around the cybersecurity market. But all right, so I don't have too much more to talk about as far as earnings go. I can't remember. Oh, I think that there was yes. I think that I'm not exactly sure if Sam's still around, but I know that he wanted me to talk a little bit about Atlassian. So I did some preliminary research on Atlassian. It seems like that they're valued at 10x next 12 months EV to sales, which is about a fair valuation. I think that when we think about Atlassian, it's like a collaboration software tool, and that's basically where a lot of other collaboration softwares are trading at right now. And I can't exactly see them getting any sort of because you got GitLab, right? And they kind of indirectly compete with GitLab. They indirectly compete with Asana. They indirectly compete with like Monday.com. A lot of these are collaboration software tools. And for me, I personally picked Monday because of the flexibility and the ability for them to actually like do a low code, no code software development. Basically means that it's like a not a one size fits all approach, but you can actually customize it to your individual organization. So for me, I've never been super interested in Atlassian. I think it's a great company. I mean, they're generating free cash flow, and I think that the valuation is pretty fair for it right now. All right, guys. I think that I'm going to come back here next week on Sunday. Do another 30 to 45 minutes. Let me know if you have any questions down there in the comments down below. And of course, I'll see you around here throughout the course of the week. And feel free to follow my Savvy Trader if you guys aren't already doing it. Have a good one.